So the bonus shares is a full distribution of additional shares to the existing shareholders. It is given in proportion to the available reserves and number of capital outside. When I give bonus shares, then in that case, I'm not giving any profits, but indirectly, I'm returning my profits. These bonus shares is known as capitalization of reserves and increasing base. The value of bonus shares, which is given to the existing shareholder, will be zero. They are given as a free of cost as a bonus. In this case, suppose I have 1 lakh rupees profit, then what I'll do? 50,000 I can give as a dividend and 50,000 I can issue as a bonus shares. When actually I issue bonus shares, I'm not giving any money outside. Rather, out of my unpaid capital, I'll subscribe the balance part and use the balance part here. So that way, the 50,000 is retained in my company. The number of shareholders are increased by 50,000 and hence I am benefited by increasing the base of my company shareholder. How the bonus share make an effect? When I issue bonus share, it always gives a positive effect because the person who are investing, they will come to know that my company is doing profits. If I'm issuing bonus shares, they also getting dividend as well as returns. So indirectly, they are benefited for long-term achievements. They are getting profitability as well as more management control and more value for their shares. So investors are happy. It gives a positive signal that firm is going for further development or progression. So in the minds of debtors, creditors, or other stakeholders, it gives strong signal of value propositions and development of organization. Most importantly, it increases the peoples who are contributing to shares proportionately. So when number of people increases, ultimately the risk associated with one person will be down. More individuals are contributing toward the organization growth, and my shareholders base will be enhanced. So ultimately, bonus shares are giving positive signal, retention of profit, and benefit towards maximization of my shareholders. Now let's talk about the other thing that is what we call stock split. When I divide the existing shares in different divisions or parts, it's called as stock split. If I'm currently having shareholders and I'm also having huge profits, so if I just give the profits, it will be called as a declaration of dividend. So if I declare the dividend, then in that case, the money will be spent outside and no retention. So what I can propose, I can go with the stock splits and similar to the bonus shares, I will give them the division of shares by changing the value of shares. In bonus shares, 10 rupees share will receive the bonus share of 10 rupees. But in stock split, what I'll do, instead of 10 rupees share, I'll make the shares of 5 rupees each. And I will try to increase number of people in the organization. So in stock split, I will change the value, that is the face value of share, and instead of one share, I'll give two shares. So if I want to give an example, suppose this is my capital and it is valued as 100. When it is a bonus shares, what I will do is I will again issue some part, it can be 50 rupees, and my total capital can become 150. In case of bonus shares, the value is added. The price per share, suppose it is 10, then the price of new share also 10. The price per share do not change. The value of total capital increases by additional issue. But when it is stock split, what I will do is this 100 rupees, instead of having 10 rupees, 10 shares, I will split the face value and make it 5 rupees, 2 shares. So my value from 100 rupees, it will be 100 only. But earlier it was 10 shares. And now the value from 10 shares will be quantity will be 20 because I divided the shareholding into 5. So in stock split, I divide the shares or I split the shares, but the shares value will remain unchanged because amount of capital 100 will remain same, but the number of shareholders they increases. And in reverse, in bonus share, I have 10 shares. If I issue additional 10 rupees shares, then I can have 15 shares. So earlier I was having 10, now I have 15. So shares are increasing. But in stock split, I just divided the existing shares in multiple formats. Any doubt about meaning of stock share, split and bonus share? Let's move further. If I compare the bonus share with stock split, let's understand stock split is division of shares and whereas bonus is issue of shares. So in stock split, I divide the shares into the other value denominations. Suppose 10 rupees shares, I divide into 3 rupees, and 3 rupees. Or it can be divided into 2.5, 2.5, and 2.5. Anyhow, whereas in bonus share, I will issue for 2 shares, 1 new share, or for 5 shares, 1 new share. So in bonus share, I'm issuing new shares. Whereas in stock split, I'm just splitting the face value. Bonus share utilizes company reserves, but in case of stock split, I adjust against the available share prices and I'll give some value. So utilization of reserve is not necessary for stock splits, whereas utilization of company reserve is applicable when I give bonus shares. In stock split, I will generally reduce the value of shares because whatever the value of share, I'm going to cut it. I'm going to split the value. But in case of bonus share, I'm going to issue share for new. So here I'm achieving 1 plus 1 is equal to 2. Whereas here what I'm achieving is 2 is divided into 1 and 1. The face value of shares for bonus share remain unchanged because I'm just issuing new shares. I'm not changing the value of shares. The purpose of split share is improve liquidity and increase the number of contribution and capital. So if more people are attached with the organization, that will give me benefit of more capital base and help me for more contribution and rate list for individuals. In case of bonus shares, it is recognized as reward for liability, so it is called loyalty reward. When I issue bonus shares, it indicates very strong profitability because bonus shares are issued out of reserves and these reserves are created out of my profits. Whereas if I do the stock split, maximum people who are not able to buy the shares, they are attracted to buy more and more shares. So I'll wait for 2 minutes. Please read the difference. Any doubt? So let's move further. So if you just see an visual impact, bonus share will increase the shares, but the price of share is same. But stock splits got about cut off shares. Now, why company issue bonus shares? Bonus shares are issued for giving strong signal about good financial health of organization. It creates a very good confidence in the minds of shareholders and it gives strong signal that company is doing progress and it has a very solid economic foundation. Company earning a continuous profits always prefer to give bonus shares to avoid overlocking of reserves and unnecessary creating hyper value in energy. Because if my reserves are increasing, it will create an uneconomic picture that I'm just creating reserves, but they are not utilized for wealth creation. So converting of accumulated profits and reserves for productive way and optimizing a balance sheet structure to avoid tax burden and other liabilities, I can use bonus shares. Many times to integrate the confidence of shareholders and to promote the healthy culture in shareholding pattern and the liability and loyalty along with the company. I promote bonus shares as a reward. When I issue bonus shares, it will give an idea that companies are progressively utilizing its resources and creating wealth for their investors. So indirectly, when giving bonus shares, it is giving an hint that my company is doing well and it's a progressively generating wealth creation for my investors. Then why companies do the stock splits? When I divide the stock split, the liability of paying dividend is reduced because the dividend is paid on face value of shares. Earlier, 10 rupee shares, if I want to pay 10%, it is 1 rupee I'm paying. Now, suppose 5 rupee share, if I'm paying 10%, point 0.5 I'm paying. Second, when the number of individuals are more with the company, the price of share goes down. It will attract more people to join the organization as investors. Normally, stock split option is chosen when the company is doing restructuring or company is undergoing change in its capital structure to enhance more strength by attracting more and more people's contribution. When I'm in the process of debt restructuring and I find that market is positive about my organization, so if I issue new shares, it will create a liability. So they do the splitting of shares so that number of shares available for retailers will be more and more investment can be significantly attractive. Now let's take example of real world actions. Infosys issued multiple time bonus shares as 1:1 in 1999, 3:1 in 2004, and so on. So when Infosys was executing this, it indicates that they are having huge profits. The trust in organization will be strong and people will be more loyal for controlling sake. In 2022, Infosys executed the buyback program. We'll talk about buyback later. They executed 9,300 shares buyback at rupees 1,750 shares, returning excess cash to shareholders efficiently. So here they manage their cash flow. So when I go with the buyback shares, I go with the issue of shares, it creates investors' confidence, improve my liquidity portion, and demonstrate efficiency of my management and their commitment to shareholders and their value creation. So indirectly, these actions make sound that the person who are appointed to control the organization, they are doing well and they are generating profits. Now let's talk about buyback of shares. Buyback means the company is in process to repurchase its issued capital. Now, when I was in insolvency concerns or when I split the shares, my number of people are more. So now the value of share is gone down. But again, I have a great margin of profits and reserves available. I have two options. Again, I can go for issue of bonus shares or I can go on right shares. But this will increase my capital. So if I don't want to increase my capital, but I want to restructure my available capital, then I adopt the strategy for buyback. The process of buyback will remain same as the process of issuing bonus shares. I need to issue the notice to the investors, call meeting. After meeting, I need to discuss with them the strategies, and then I need to file a resolution. And this resolution should clearly mention the process of buyback. In buyback, what I'll do, earlier I split the shares. Now I can propose to repurchase the some part of shares so that the value of reserves is utilized properly. It will give my capital optimization and progressively restructuring of controlling authority in organization. Buyback of shares give another strong signal that company has ample of profits and these funds are utilized for generation of their income. So they give a positive impact on share prices, earning per share, and overall dynamics and financial strength of a company. I'll wait for 1 minute. Please read the slide. let's move further. Buyback of share is called a corporate restructuring of shares. In buyback, the share values are reduced. So here again, I'm reducing the number of shares available. For example, in stock split, what I do, I have existing 10 shares. So so I was having 10 rupees share. I divided into 2.3 rupees, 3 rupees, and 3 rupees. Suppose it is 3.3 and 3.3 and 3.3. Now, when I do the split of shares, then in such case, these shares are split and they are divided in multiple shares. So what I achieved is number of more shares. Now, when I was doing buyback, what I will do is I will repurchase these two shares. So earlier I was having one share, I had split into three. Now these three shares I will buy back, suppose two, then one share is available. So what I'll do, I will pay them the face value or decided value, and I will reduce the number of shares which I am having. So in buyback, I will systematically repurchase the issued capital with a targeted volume based on earning per share. So this will reduce my total outstanding number of shares and give the boost about strengthening my capital structure. This buyback of share is available only in case my capital is having excessive capital reserve. This will give again the boost about re-strengthening and restructuring the capital of my organization, and this will help me to reanalyze the quantity of capital. Buyback of share is also known as dilution of my shares invested and gives more good financial leverage. Because when I buy back shares, I was having earlier 10 rupees share, I split it in 5 rupees. Or I have second case, I have only 10 rupees shares and these are out as 10. So now I reback 5. So only 5 are available in the market. Or in case of split, I back one share. So only one is available. So it means earlier my capital was 100. Now the capital is again changing its value to 50 rupees. Why? Because I am buying my shares. So when I do the buyback, I'm repurchase my shares and reallocate the available quantity or reduce the quantity available in interest for my shareholders. So the buyback is exactly the reverse process of split of shares. Please read the slide. If any doubt, I'll re-explain. Any doubts? Please post in chat box. I'll move further. Now, why companies buy back shares? As I said, this gives an hint of undervaluation because from 10 rupees, I'm going to less number of shares or less quantity of shares. Second, since the price of share is going down, earlier I was having 10 rupees price, and if return was 5 rupees, then it is 50%. Now, when the price of share is reduced, so suppose 5 rupees is the price and earning is 5, then my earning per share will be 100%. So reduced price will enhance my earning per share. Secondly, it will create a defense against hostile takeover, that is forceful takeover or merger. It is an attempt to increase loyalty and trust again in an organization, and this will benefit for revaluation of capital. This will also call as return of surplus and loyalty. Many times for dividend obligation and tax management, the buyback of share is promoted. So if I do the buyback of shares, then it will help me to promote the value of my share, my earning per share, ultimately the value. Second, it will give reduction in value of assets, and it is one of the tool I can use for avoiding the financial stress or effect over my organization, like hostile takeover, merger, then dividend obligation, or my tax policy. Please read this slide. I'll wait for 1 minute. So let's move further. Now, what are the buyback methods? The first method is open market method. In open market methods, the shares are purchased based on the current prevailing market price, or they are purchased based on ratio of earning price per share. The second method is a tender method. where typically company announce the lot of shares and it offers a price for shares. For example, the face value of Infosys share is 1000. What I will offer that I'm ready to buy back 5 shares for 6000. So I can make a tender price offer. It can be at premium or at discount, or I can directly buy from open market my shares. So these are two methods which are used for buyback. One is a open market and second is tender offer. Now there are some drawbacks about buyback of shares. The first is it will create a disturbance in the market and it will not genuinely reflect long-term value creation because when I do the buyback, I'm reducing the investor's stake in my organization. Secondly, I'm utilizing my available resources for the buyback, which will not give profitability and returns for long run. It's an my temporary adjustment, which I can achieve a short-term goal of managing my available excess cash flow. But in long term, it will not be generating any source of profitability or income to me. In case if I compare the other options like split, bonus shares, the option of buyback is always sounds to be not so good because here the undervaluation chance may reflect the company is in financial issues and it is going for dissolution process. Similarly, the opportunity cost for investment in research, innovation, expansion, employee promotion and welfare is compensated against capital buyback. So if I do the buyback, it will artificially creating price hyping about my shares, but may or may not impact the potential compensation towards research, employment betterment, and productive capital investments. Let's talk about a case study of Microsoft. Microsoft was having 35.7 billion investment. They declare the massive buyback program over 2 years period. That what they do is 419 million rupees shares they buy back, and this will achieve them 47% gain. Now, when they buy back the shares, it demonstrates effective capital allocation and can contributing by creating value. And in this case, their profit, which is booked, the outflow is compensatedly managed towards generating the better value proposition and a reformation of capital holdings. Now, how this decision of buyback, split, and monoshare impact? First, they will impact on number of shareholders. They will impact on earning price share. They will impact on liquidity and dividend which is issued. And most importantly, they will optimize entry and exit of new people in the organization. So when I have buyback shares, it's a value creation. Bonus share, it's a loyalty. And split, it calls about restructuring shares. So the basic impact will be on a quantity, dividend payout, capital flow, and management of reserve. So if I'm a corporate person, I want to restructure and reorganize my capital. I need to take due care that whatever the decisions I'm making, they are making a positive impact to myself. They are generating some additional benefits to myself. And that's why it is more important to go with a good strategy of corporate restructuring. So this is summary. Please read the summary. I'll wait for 2 minutes. So anybody any doubt? Anybody doubt about bonus shares, stock split, and so on? Okay. So let's talk about now. Let's talk about the theories of dividend. We got three theories: Walter theory, modern theory, and approach. These three theories are part of your syllabus. So let's talk about the first theory, Walter theory. James E. Walter, he proposed the first theory, which is called as Walter's theory. Under this model, he talks about dividend policy and value of firm. Now, please remember what is meant by dividend policy. Dividend policy means the strategy which I am following, the method or the steps or the kind of dividend I'm paying. Whereas the value of firms talks about the profits, the wealth creation, and overall progress of organization. So let's see what is his propositions. Now, as per him, why dividend policy is important? Because how much dividend I'm paying, it will create an impact. How many people are happy about my organization investment? If I'm maximizing the value by paying maximum, it is short term. If I'm issuing bonus shares, right shares, or I'm doing buyback, it will create more earning per share. If I retain my capital, it is most profitable and generating more returns. So indirectly, when I'm doing dividend policy decisions, I need to take in concern the financial validity, the financial propositions, and also understand the whether my firms are progressive or they are creating some value or not. So my dividend policy will make an impact for earning per share, their long-term association, their quality, and their trust in decision making and growth of organization. What Walter has said that dividends has various options like reinvestments, share compensation, and value creation. So this model will link the dividend policy about the strength and value propositions associated. Now, who is James Walton? He was a financial researcher. He developed his model during 1950s and 1960s era. He is recognized as modern financial analyst. According to him, if I have more return earnings and more internal wealth creation, it will create more investment returns and indirectly the trust among the investors and increase the value of firm. He directly opposed the view that dividend policy is irrelevant for value of firm. As per him, whenever I declare a dividend, whenever I give the bonus shares, whenever I issue the right shares or any other, the value propositions, whatever I'm changing, it will directly give the trust and confidence to the shareholders, and it is indirectly helping me investors to raise their trust. So, as per him, investors' trust is directly linked with the dividend which I'm going to pay. Now, the core concept, he talks about strong value that I want dividend to be paid. If dividend to be paid, it is always related with the cost of capital. So he has compared the two factors, rate of return and cost of capital. So the return a company is earning can be reinvested, can be reutilized, and they will create the value in investors' mind, and that will help for their trust and long-term association with company. The cost of capital means how much money is received by investors. So he has compared internal rate of return, that is R, and cost of capital as a key. So he has given three rules. So in first rule, if R is more than cost of capital, that means if I have higher returns and they are reinvested in company instead of paying dividend, then it will give growth scenario. So when maximum money is retained in the organization, it will give me a growth scenario. But in reverse, if I have high dividend paid and poor retention, then this will call immature behavior because money is not retained in the organization. And for further progress, I need to depend again reborrowing from outside source. So as per him, if I have equilibrium, then the dividend policy also become irrelevant because the payout ratio and the growth they are not mature. So he strongly says I should go with maximum retention if I want a growth. If it is an equilibrium, it shows ignorance of value creation. And if the returns are maximum, then it shows poor investment decision because returning cash to the shareholder will invite more borrowings in future earnings. So I'm not retaining anything. The delicate balance between investment and capital determine the optimum capital strategy. So as per him, I have to retain maximum capital, increase my capital base, and that will help for value creation and earning per share. If I retain maximum, it gives a strong signal that I'm going to further make the growth and progress. Now, what is the formula? Market price per share is equal to D stands for dividend, K stands for cost of capital. So, dividend divided by capital plus rate of interest in bracket earning minus dividend divided by cost of capital, and this whole sum is again divided by cost of capital. So I'll wait for 2 minutes. Please read the formula. Then I'll explain the formula. So if I analyze this formula, what I find it is dividend and cost of equity having weightage of returns and they compare with earning and dividend declared. So overall cost of equity is most important factor and that is linked with dividend per share. So here they will talk about the reinvestment more. If earning minus dividend is higher, then the price of share will go down. For example, if dividend declared is 10 rupees, sorry, and cost of capital is 10, then the rate suppose 100% and earning is 10 minus 10 0 divided by k, that is 10 plus 10, then it becomes 11. So for 10 rupees, I am paying 11 as a dividend, and this extra dividend what I'm paying 11 rupees is ultimately resulting in degrading the value of my firm. So as per him, the ratio of E minus T I have to take care is have maximum gap. This ratio, if enlarged, it means the lower dividend my earning is 100, and if my dividend is 1, then 99 is available for future development. So you want this to be large. As per him, the value of cost of capital can be changed or manipulated. It can be 10%, it can be 5%, it can be 3%. If this difference is maximum, then it will indicate the organization is going for expansion or future development. In that case, my cost of capital will come down because the investors has guaranteed that organization is going to make future profits. So the value of my shares ultimately will benefit in rising, and it will give confidence for investors. Now let's move further. Now there are almost 3 minutes remaining, 2 minutes remaining to finish my session. So I just give overview what we are going further. We are going to talk about the formula, then assumptions, then we'll talk about how it works and real world examples. So this is about Walter. So after Walter model, what I'm going to do is that we are going to discuss. Now we are discussing about Walter model, then Gordon model, hypothesis, and this will end fifth. Now the only portion remains is a fourth unit. Otherwise, we are done with the syllabus of AFM. So please read the AFM syllabus. And now I'll quit the meeting and we'll join at 8 a.m. for direct taxation numericals. So thank you all of you being part of this session. We'll meet at 8 a.m. for next session. Please remember, we are monitoring your attendance for the sessions because this attendance is linked with your OGT. And those students who are my mentee or Sriram sir mentee, please ensure by 17 or maximum 18, you are submitting your OGT report in all details. Thank you all of you. Wish you wonderful day ahead.